Welcome back to Explain the Charts, your go-to source for in-depth market analysis. Today, August 15th, 2025, we're conducting a comprehensive review of the NZDUSD currency pair, integrating both recent news and crucial chart data. The latest headlines confirm a significant pullback for the New Zealand dollar. It has seen a notable decrease of over 1% against the US dollar in just the past 24 hours alone, retreating from what was a two-week high. This current slide in the mid-0.5900s is primarily attributed to a goodish recovery in the US dollar. A key technical point highlighted in the news is the pair's rejection near the 0.5970 level, which crucially coincides with its 50-day simple moving average. Despite this immediate weakness, there's a prevailing sentiment in the broader financial markets. Many analysts anticipate a weaker US dollar in the medium term due to expected Federal Reserve interest rate cuts, especially in an environment of rising inflation. This anticipation of Fed monetary policy easing typically translates into bullish pressure for currency pairs like NZDUSD. In fact, some immediate forecasts suggest that NZDUSD could attempt a minor rebound, potentially rising towards 0.595251 within the very next 24 hours. Now, let's transition to the daily chart to visualize how these fundamental and technical forces have manifested in price action. Looking at the broader price action over the past year, excluding what appear to be severe data anomalies or flash crashes with extreme low wicks, the NZDUSD has largely been trading within a well-defined range. Its movements typically oscillate between the strong support area around 0.5500 and notable overhead resistance near 0.6300. Focusing specifically on the recent period, from late July 2025, we observed a steady, multi-day climb from roughly 0.5900. This upward momentum culminated in a distinct peak near 0.6080 on August 13th. This ascent perfectly aligns with and confirms the two-week high mentioned in today's news reports, indicating strong underlying demand during that particular period. However, as also reported, the rejection at this higher level was decisive, leading to yesterday's significant 1% daily decline. This immediate and sharp price reaction clearly validates 0.6080 as a critical, multi-month resistance point, confirming the technical significance reported in the news. The latest daily candle, ending yesterday, August 14th, stands as a clear testament to this bearish reversal. While our 15-minute chart holds the most immediate data, let's take a quick look at the 1-hour chart, using its available historical data from late July, to understand how similar technical principles play out on a shorter time frame. During late July, we observed periods of clear intraday trends and swift reversals, such as the sharp drop from 0.6026 on July 28th, immediately followed by a period of tight consolidation. Notice how critical levels like 0.5970, seen here acting as a ceiling in late July, often reappear as resistance or support, similar to its reported role on the daily chart and in today's news context. This pattern demonstrates that recognizing dynamic support and resistance levels is a crucial skill applicable across various time frames, even with older data. Higher volume spikes, such as those accompanying the sharp July 28th decline, consistently indicate periods of strong conviction and increased participation among traders. These historical patterns on the hourly chart underscore the continuous importance of observing momentum, market structure, and key price thresholds. Now, let's turn our attention to the absolute latest price action from the past 24 hours on the 15-minute chart, which directly reflects today's news. Here, on the 15-minute time frame, we see the real-time implications of the news we discussed at the top of the show, capturing the major price action from August 14th. The severe decline from yesterday's highs is graphically evident with a series of aggressive bearish candles, highlighting the strong selling pressure. Immediately after this sharp descent, the NZDUSD pair entered a tight consolidation phase, largely holding its ground between 0.5915 and 0.5920. This narrow range suggests that the intense selling momentum from the previous day has somewhat exhausted itself, and buyers are attempting to establish a temporary floor. Short-term traders should pay close attention to a decisive break out of this current tight range for immediate directional clues. A sustained move above 0.5920 could trigger a minor relief bounce, while a breach below 0.5915 would likely invite renewed selling pressure, targeting lower supports. Let's synthesize these observations from both news and charts into clear bullish and bearish arguments for NZDUSD moving forward. Reasons to be bullish. The most compelling long-term bullish factor stems from the widely anticipated expectations of the Federal Reserve beginning to cut interest rates. If the Fed indeed pursues an easing monetary policy due to persistent inflation or signs of slowing economic growth, the US dollar is almost certain to weaken across the board. This broad USD weakness would naturally provide significant and sustained upward momentum for NZDUSD, potentially pushing it back towards its earlier highs. From a technical standpoint, if the current consolidation around 0.5915 to 0.5920 holds strong, and the price can reclaim the psychological level of 0.5950, it would open the door for a short-term recovery. A strong push and sustained close above the critical 0.5970 resistance, especially if accompanied by significantly higher trading volume, would unequivocally validate a more sustained bullish reversal, potentially targeting the August 13th high of 0.6080. Reasons to be bearish. The immediate short-term outlook, however, is distinctly bearish, as evidenced by the sharp and high-volume rejection from the 2-week high. The failure to sustain above 0.6080 and the subsequent decisive break below 0.5970, which is also the 50-day SMA, signals strong overhead resistance that proved impenetrable. Should the current temporary support around 0.5915 to 0.5920 fail to hold and break decisively, the path of least resistance would be further downwards. The next significant support level on the daily chart is found at the late July low of approximately 0.5880. A decisive breach of 0.5880 could trigger further declines, potentially bringing the early July lows around 0.5800 into play, thereby reinforcing a strong bearish trend in the near term. To summarize our in-depth analysis on NZDUSD today, August 15, 2025. The pair is currently trading near 0.5919, having experienced a sharp 1.01% drop from its 0.6080 peak, consistent with recent news. This decline was a clear rejection at a significant multi-month resistance level, aligning perfectly with the current news narrative of USD recovery. For the short term, immediate overhead resistance levels are crucial, first at 0.5950, and then the more formidable 0.5970, which is also the 50-day SMA. On the downside, initial support rests precariously at the 0.5915 to 0.5920 consolidation zone, seen on the 15-minute chart. Below that, critical support levels are 0.5880 and then 0.5800, derived from the daily time frame. In the very short term, say the next 24 to 48 hours, I'd give a 65% likelihood of further downside or at least a retest of the 0.5905 low if the 0.5915 support does not hold. A confirmed break below 0.5905 would strongly reinforce bearish momentum, targeting 0.5880 next. Conversely, a strong rebound towards 0.5950 and potentially 0.5970 has a 35% likelihood, requiring a significant catalyst such as unexpectedly weak U.S. economic data or new dovish remarks from the Federal Reserve. Always monitor trading volume. Increasing volume during directional moves confirms conviction and strength. Keep an especially close eye on upcoming economic releases, particularly any inflation data or central bank statements from both the US and New Zealand. These events often serve as critical inflection points that can rapidly shift market sentiment. Remember, these charts are dynamic, So stay informed, adaptable, and always apply sound risk management to all your trades.